You've heard traders throw around bull market and bear market like everyone just knows what they mean. You nod along, but secretly you're thinking, okay, prices go up, prices go down, what's the big deal? Here's the thing, you're not wrong, but you're missing the one insight that separates confident investors from the crowd that panics at every headline. Hey, it's Ollie, and today I'm going to make bull markets versus bear markets genuinely click for you. I've spent years watching how different investors react to market cycles, and there's a clear pattern between those who build wealth and those who get whipsawed by every market move. The difference isn't luck or insider knowledge, it's understanding what these market phases actually mean and why they happen. And once you see it, you'll never look at market headlines the same way again. Let me paint you a picture with two investors, Sarah and Mike, both starting with $10,000 in early 2020. Sarah understood market cycles, Mike just saw scary headlines. When the market crashed 34% in March 2020, a textbook bear market, Mike panicked and sold everything, locking in a $3,400 loss. Sarah recognized this as a temporary bear market and actually bought more. Here's the beautiful part, by the end of that year, the market had not only recovered but hit new all-time highs. Sarah's portfolio grew to over $15,000 while Mike was still sitting in cash, having missed the entire recovery. The difference wasn't luck, it was understanding what bear and bull markets really mean. Here's the definition that matters. A bull market is when prices rise 20% or more from recent lows, driven by optimism and confidence. A bear market is when prices fall 20% or more from recent highs, fueled by fear and pessimism. But here's my favorite memory trick that'll stick forever. A bull attacks by thrusting its horns upward, while a bear swipes its paws downward. Think of the animal's fighting styles, and you'll never forget which is which. And here's the part that might surprise you. Historically, bull markets last much longer than bear markets, but the bear markets get all the scary headlines. Pause for a second and guess, if the market drops 15% from its peak, are we in a bear market or something else? Take a moment to think about it. The answer is, we're in a correction, not a bear market. A correction is typically defined as a 10 to 15% decline. It's like the market taking a breather, not a full reversal. This distinction matters because corrections happen all the time and are completely normal, while bear markets are rarer and signal deeper economic concerns. Now let me show you the four forces that drive these cycles, because understanding this is like having a roadmap. First, there's the economy itself, GDP growth, employment, consumer spending. Second, interest rates set by the Federal Reserve. When they're low, borrowing is cheap and stocks look attractive. Third, corporate earnings. If companies are making money, their stock prices typically follow. Fourth, and this one's huge, investor sentiment, the collective mood that can turn a small dip into a panic or a modest gain into euphoria. Here's what most people miss, these forces don't work in isolation, they feed off each other in powerful cycles. Let me tell you about the biggest mistake I see investors make, and it happens in every single bear market. Picture this, the market drops 25%, the headlines scream about recession, and your $50,000 portfolio is now worth $37,500. Your gut screams sell before it gets worse. But here's the brutal truth, if you sell at that moment, you've just guaranteed that $12,500 loss forever. Meanwhile, every major bear market in history has eventually ended, and the market has gone on to hit new all-time highs. I'm not saying it's guaranteed to continue forever, but the historical pattern is clear. The investors who build wealth are the ones who understand that bear markets, while painful, are temporary speed bumps on a longer journey. Here's the strategy that separates wealthy investors from everyone else, and it's simpler than you think. Time in the market beats timing the market. Let me show you why this works with real numbers. An investor who stayed invested through every bull and bear market from 1980 to 2020 would have averaged about 10% annual returns. But an investor who missed just the 10 best days over those 40 years, trying to time their way in and out, would have averaged only 6%. Missing 20 of the best days? Their returns dropped to just 4%. The lesson is crystal clear: those best days often happen right after the worst days, when everyone's too scared to invest. Alright, let's make this practical. First, if you're investing regularly, don't stop during bear markets, that's when you're buying shares on sale. Second, keep 3 to 6 months of expenses in cash so you never have to sell investments at the wrong time. Third, educate yourself about the companies you own so you can stay confident when prices get volatile. And fourth, remember that bear markets create some of the best buying opportunities for patient investors. Before we wrap up, I'm curious, have you ever panic sold during a market downturn, or held strong? Drop your story in the comments. I read every single one and love hearing about your experiences. Look, understanding bull and bear markets isn't just about memorizing definitions, it's about building the confidence to stay calm when everyone else is panicking. The next time you see headlines about market crashes or euphoric rallies, you'll know exactly what phase we're in and how to respond. Remember, markets cycle, but patient investors build wealth. If you want to dive deeper into smart investing strategies, head over to nexusaicalls.com. We've got tools and insights that'll keep you ahead of the curve. Until next time, keep learning and keep growing.